After years of global disruption from pandemics to geopolitical conflict, investors are now reassessing how they value risk. With the rise of alternative currencies and narrowing returns between equity and debt, questions are mounting about the traditional models that underpin our global markets. Joining us now is Nicholas Quinn. It's good to have you with us on the program. What exactly is risk fatigue and how is it showing up in the markets at the moment?
Great to be back again. Yeah, it's something we've discussed a little bit recently over the last sort of 4 or 5 years. You've seen naturally COVID, we've seen Russia and Ukraine, you've seen all the other stuff that's going on in Israel and Gaza, and then most recently, the United States bombing Iran. And some of these things, with the exception of maybe the temper tantrum of Donald Trump, the tantrum rather, most things are not seeming to move markets the way they would have 10 or 20 years ago, where things really did move markets. News and output would say, hang on a minute, what's going on here? We need to reassess. The market just seems so fatigued by everything that's occurred in the last 5 years that traditional things that move markets aren't doing it the way they used to, or causing the volatility that they did in prior periods. Partly this could be due to passive investing and people just loading up and continuing to invest and save away as things go on and getting more familiar with that concept. But for active equity investors like ourselves, we're always trying to find the next edge and what's going to dislocate markets. And there does seem to be that decision fatigue and information fatigue because of so many things that are coming at the market.
Yeah, it does feel like a bit of a watershed moment we're on the precipice of. But how are alternative currencies challenging the USD's dominance, historically speaking?
Yeah, it's been a play that's been playing out for the last sort of 10, 20 years. Naturally, China and its exports and the amount of things that they are producing for the global economy is very relevant. And quite a while ago, a majority of the amount of their settlements were done in USD. Over the last 10, 20 years, we've seen them not only settling more by domestic currency, but as the last few years with Russia being excluded from the global economy, they're now settling more in their domestic currency, both their exports and in their trade. And what that means for the USD dominance that it's had for such a long time. And I guess the longer term or forward outlook question is, what is the importance of the USD? How relevant is it going to remain? And is it always going to stay as the international trade dollar settlement of currency? And questions remain around that. And then on top of that, you've seen the rise of cryptocurrencies. I've been quite the skeptic along the way. And
Yes.
I think I'm starting to turn the page a little bit myself, saying this concept is not going away. People are realizing can be a valid method of settlement. There's some stuff in Australia at the moment now looking at mortgages that are backed by the blockchain and other coin derivatives. And what does that mean for the future of, as we've said before, trade? People need something to trade for the other things that they need. No one wants to be able to go to 7-Eleven and pay for their petrol with bananas. That doesn't work. So there needs to be a form of money that is the form of exchange in all transactions. And as I said, what does the USD play in that role? And what other is the rise of not only the Chinese currency, but these alternative digital currencies and the role they play in that settlement economy?
Yeah, certainly going to be interesting to see where we're headed next. Why does the risk premium model still matter, though, for investors, at least for the time being?
Yeah, it's been a bit of an issue over the last sort of 3 to 5 years, especially since COVID. Historically, as we all know, equities on average should, in theory, return a higher profile return than debt. Again, over that long term, they suffer from more volatility. They're generally less consistent. They don't have first security, which debt often does in terms of a default. And what does that mean for investors who are willing to take on equity risk? 3 to 5 years, you've seen the rise of private credit. There are some fantastic opportunities out there for people to get involved in a debt style instrument with quite reasonable returns that, whilst not guaranteed, are a little bit more certain in their cash flows if all goes to plan and the project doesn't go on to fail. In equities, the opposite has almost been true. There's been pockets of exuberance, there's been pockets of downfall, and it does become more of a troublesome time to say, well, when should I get in and when should I get out? The longer term question is get in and don't get out. Long term compound investing is still probably the best way to go. But that risk premium doesn't seem to have held as much in the last 5 years as it should have. Having people go, right, I'm taking on additional risk. I'm at a lower part of the insolvency food chain. If something goes wrong, I need to be compensated for that risk. And at the moment, equities just don't feel like the place to be for some investors who say, I'm just more willing to go into the private credit sphere. The longer term question says, how long can that hold before private credit faces a reversal? Interest rates now globally are starting to come off, including here to a small amount. So moving back into equities may be the play for the next 12-month outlook.
Yeah, certainly interesting times ahead. Nicholas, thanks for joining us on the program. Look forward to speaking again down the line.
Thanks so much for having us.